Welcome everyone, episode 42 of the Wide Lens podcast. I'm joined here with my co-host John Sim. We're going to cover the latest topics in financial markets this week, and we are recording this on Friday, the 12th of May, 2023 at 10 a.m. Going to kick off with market wrap, and I'll bring this chart up, and I've got the right chart today. We've got the Aussie market leading the pack over the last week, up a bit over 1%. The US stock market flat, the NASDAQ up about 1%, European stocks down 1.5%, and we've got the emerging market stocks down about 1%. Pretty mixed in markets over the last week. There's been a lot going on, and we'll talk a lot about that today. I'll bring up the year-to-dates, have a look at some of these numbers. Again, the NASDAQ's just well and truly pushing over that 20% mark. We're at 22.34% total return for year to date. We've got the European market edging a little bit lower over the last week or so, up about 13% for the year. The US stock market, after falling earlier this month, coming up, trying to edge up a little bit now, up about 8.5%. The Australian stock market just seems to be not really doing much. It's backfiring a little bit and tracking sideways, up about 4.5% year to date. And emerging markets continue to be pretty average at the moment, up about 1.67% for the year. And we'll talk a little bit about some of the drivers of the markets shortly. Hey, are you going to talk about AI today? Because the NASDAQ, to me, and with what Google just announced last night, is pretty incredible. Do you want to?
Pretty amazing.
Did you have that to talk about? Or?
I didn't have that to talk about, but I did briefly see some things about what they were doing. One of them was the pre-filled emails, right? Which was
I didn't see pre-filled emails. I think that caught my eye was the work they're doing with Adobe Firefly and the images that Adobe are now generating just using voice. So, for example, I think the example they use is show me a unicorn with a cake at a children's birthday party, and you speak to Baird, and then that just generates this incredible, just like that incredible image.
Amazing.
So that
was kind of what we were talking last week about the children's story. Like, it would just be so easy to do that now.
Yeah, 100%. And I've been looking at a number of AI programs that can do a lot of this generative stuff, but there's still quite a bit of mucking around. Like, you can't just speak to it and it creates this incredible picture off the bat. There's a lot of work that needs to be done.
Yeah.
And you got to create sort of almost template likes, and then the AI then fills it in, just changes it. So, but I don't know. Did you see anything else with Baird?
The other thing I saw was, if you take a photo, they had an image of a kid with a balloon. But the balloon was blown away.
I saw that.
And the AI could effectively correct that and fix that up. So the balloon was effectively flying in the right direction, and the kid looked, cute, and they just moved the chair over. Yeah. So this, some crazy stuff being done.
What from what I can see, Google are doing, they're just pushing uber hard to compete with Microsoft and with Microsoft's ChatGPT, and that plugging into PowerPoint, Excel, Outlook. There's no way Google would just let Microsoft have that free kick, right? And so you would expect that they've got a whole division just working in their AI in Google, in the AI division, just pushing really hard. And they've got so instead of doing it so the way I see it is Bard is kind of their interface, and they've got links with like Compose AI and all these other AI programs that specialize in different things. And they're building those connections to link with a lot of Google's software.
Yeah, I mean, it's really interesting, and I think there was a study done by the WHO, and they're saying the number one. And they're saying that one of the biggest drivers in new employment is going to be AI. pretty crazy. Look out.
I was just going to quickly bring up...
Coming for your jobs.
I just want to have a look at how many times... Oh, that's right. Google... This was interesting. In Google's last earnings season, they mentioned AI. Guess how many times AI was mentioned in their earnings report?
20?
140 times.
140 times.
And you contrast that to... you know what? I'm going to bring this up now, actually. I'm just going to put this in the doc so you can bring it up. Just under the... There you go. Can you see that? I've just brought that up. And for those watching, I've brought that up now. So hopefully you can see that just towards the top of the doc, John. Tech giants are all about AI this earnings season. So have a look at Q1 2022 versus Q1 2023. Alphabet, Meta, Microsoft, Amazon, Apple. Why Google, Alphabet. But have a look at the number of times AI was mentioned 1 year ago compared to today. Have a look at Apple, which is interesting. Microsoft, Meta, and Alphabet.
They're pushing hard.
I don't know. Is
Apple looks like it's going in another direction with trying to take bank deposits.
I'm not. I mean, that's working quite well for them, obviously. But I just wonder. It looks like we're on a bit of the AI bubble train again. It went quiet for a little bit back end of 2022, but we're certainly back at it again now.
I think they were probably hard at work trying to work out their strategy around AI.
Yeah, look, I don't know. I'm super receptive to it, and it'll be really interesting to see what comes out of it.
Actually, I want to go to director's cuts quickly.
Yeah,
because it's just on topic, and we may as well have a look at that. Look at this Twitter post. A study found that ChatGPT outperformed physicians in a study in the Journal of Internal Medicine.
Saw that, yeah.
Researchers compared the quality and empathy of AI responses to patient questions. And they had licensed physician rate the responses in terms of the quality of information provided and the bedside manner. ChatGPT outperformed handily on both metrics.
Look, surprising or unsurprising, there was also, and I think there's also an ETF out in the US that basically buys stocks based on AI, and that ETF outperforms most stock pickers.
Wow.
But guess who it doesn't outperform?
Who?
The index. I'm not kidding you, man.
Oh, wow.
Right? So if you've got like artificial intelligence outperforming like a team of 20, 30 researchers who go do management visits every month, like, you know, if they can't beat... If artificial intelligence is beating them, they can't beat AI. AI can't beat the market. Like, what chance do they have of beating the market? No, that's really interesting. It's surprising, but not surprising at the same time. Is there anything else you want to jump to and just ruin the sequence of this doc today, or what?
No, that's good. Let's continue.
All right, cool. Let's bring this chart up now. This is the price of a dozen large eggs in the US. So I don't know if you know, but eggs were like, the price of eggs just went berserk in the US.
Like gold?
I don't know if it went up as high as gold did. I don't know what the hell's gold's doing, by the way. But I think there was I don't know what bird flu there was again. Price of eggs just went through the roof, and US... those that love eggs and living in the US are sighing relief at the moment because they're back down to pre-pandemic levels. But that's not really the topic. The real topic is this. It's year-over-year change in CPI. We had US inflation come out at 4.9%. The expectation was 5%. But the most important thing here is that we're starting to see, well, clearly, inflation or disinflation is coming down. Now, Wall Street thinks that the inflation data is now clearing the way for the Fed to now start hitting the brakes. it's the first sub 5% reading we've had in 2 years. And having a look at the market-based probability with where Fed's target funds rate are sitting, it's jumped from what was about 78% to 95% to a hold.
Wow.
So the market's basically pricing in a guarantee of a hold. I mean, it's not 95%. But then again, we saw what the market was pricing in for Australia. We saw what the RBA did as well. So it's clear, it is very clear to me that the rate hikes are now starting to make their way through the cycle and through the system, I should say. But also a lot of, I don't know if the whole transitory concept of what happened post or during COVID, whether all of that is still a transitory thing and whether a lot of that is now abating and prices are starting to come down. You know, we've talked to a number of developers and builders in the building game that are talking about price rises, and we're just not having the price rises anymore.
Yeah.
But that's not to say prices are going down. It's just the rises are becoming much smaller.
Correct.
I mean, we're just working off super high bases. Like, you just cannot keep going at that pace,
you
right?
can't grow at that rate forever.
The jobs market remains uber strong still in the US. We had job numbers come out again, and the jobs market is just super robust. One of the other challenges, though, the US is facing, and I don't know if we'll start facing that in Australia now, is, I'll bring this chart up. This is from Apollo. The average number of offers received per sold property starting to recover. So we had a low of a bit over 2. Now we're hitting a bit over 3. I mean, this is well and truly, well, the numbers we're seeing now are well and truly above what we saw pre-pandemic. But during the pandemic, when we were not seeing any of those numbers, I mean, if you cut that sort of head off that longer term average, it starts to make a bit more sense. Apollo is saying, quote Apollo, the housing market has started to recover, and this is a problem for the Fed because more demand for housing will boost home prices and rents. And with housing having a weight of 40% in CPI, this will make it more difficult to get inflation currently down from 5% to 2% inflation target.
That's an interesting driver they have there. Yeah, 40%.
40% is
massive.
Is classified shelter. Now, you and I have talked about how one of the problems in the US, notwithstanding the fundamental undersupply, people are also not moving home because they've got these 30-year fixed rate mortgages, right?
Yeah.
And so that's becoming even more problematic for supply in the US. So there's this conundrum now, and I saw an article in the Fin this morning which talked about a very similar concept where we've got low supply in the property market, which is starting to push prices up. But now you've got like 135 migrants hitting our shore this year, and all of a sudden we're going to be even more short of property.
Yeah.
People are throwing around the question now as to whether or not the 2% target is dead and whether we need to start targeting something more realistic. People are throwing around the 3%. What have we got in Australia? 2.5 to 3?
2.5 to 3.
Is that the number in Australia?
I think so.
Maybe that's a little bit more realistic, and with time, I think that'll come, especially with the CBA chart that you shared a couple of weeks ago. There's a whole bunch of other things I want to go through, but I'm just curious maybe to just stop there and get your take on, offers received on properties in the US, that being 40% of CPI falling to where it is. Like, what are your thoughts on this so far?
Yeah, I mean, not dissimilar drivers that we have here, and that the Fed budget, which we're going to talk about later, tries to deal with in terms of affordable housing and increasing supply to reduce the effects of these big rental hikes that we're seeing as a result of a lack of supply. So whether the US has a similar standpoint in terms of how they're going to solve this housing issue to what we do here in Australia, I don't know, but they're going to have to do something if they've got this problem with a supply constraint effectively.
Well, if you're going to bring it up, let's keep moving and let's chat about that as well. Again, Apollo, there were some really interesting observations made with the credit officer survey that was just released out of the US. And look, I'm not going to bring these charts up, but I'll try and explain these for listeners and for watchers as well. And for your benefit, John, so the headline's bank credit conditions now at 2008 levels. So demand for corporate loans is literally at 2008 levels. I mean, John, if you want to have a look at it, it's on that link, the Apollo link. You can have a look at the charts from Torsten. So demand for corporate loans is at 2008 levels. The demand for commercial real estate loans is at 2008 levels. The bank's willingness to lend to customers is approaching 2008 levels. And there's some new data coming out that it'll be interesting to see how this plays out. I mean, the data's coming out week by week, and so it's being closely watched. The banks are tightening lending standards significantly near 2008 levels.
And we've been talking about this for weeks in terms of the liquidity, right?
We have, and there's a chart I want to show shortly. Credit card delinquency is at 2008 levels. And credit conditions for consumers, interestingly, is much tighter than 2008 levels as we sit here now, because what we've got is bank loan officers now becoming far more stringent on how they're making assessments.
Yeah.
To the point we've talked about for weeks, and in separate conversations we have, the elephant in the room is how do you value unlisted assets? What is the value of an asset that can't be valued? I mean, the only comparison that can be made is your listed counterparts. But why does no one have the balls to put their neck on the line and say this asset's worth this? I mean, you've got valuers running around trying to value these things.
Well, yeah, the valuers are running around and they're basing their analysis on historical figures, right? They can only
historical what? Unlisted?
Historical sales or
why don't they
historical comps?
But why don't they use comps for
they can't use future-based comps, right?
No, but public. Why can't you use public markets as a proxy for valuation? Because that'll open up the dam wall. That'll start cracking that damn thing.
Yeah,
if you start getting valuations.
That's all sentiment, right? Public market valuation.
Yeah, but isn't it the same thing? Like, if you put something up for auction, isn't that also about sentiment, about how people are feeling?
So are we talking about trading businesses or property now?
Property.
So,
I mean, you're 100%. You're right. There's separate. I mean, there's businesses and there's real estate.
So if we talk about property, if you're talking about listed property, I mean they're getting their properties revalued and not seeing too much of a valuation impact, right? I think I was reading about who was I reading about? One of the big supermarket REITs, the softening was only 77 basis points or 70 basis points. And another one was only about 23 basis points in terms of revaluations, recent revaluations.
Why are the stock prices getting smashed then?
Because everyone else is expecting that there should be more impact to market value. So the actual investors and shareholders are expecting that there will be further impacts to valuation.
So who's right?
And they're building that in on a forward-looking basis.
Yeah, so who's right? The market or the...
Well, that's why we talk about that disconnect, right, between what the market actually thinks and what's actually happening. Somebody will eventually be right and there'll be an arbitrage there of some sort.
Right or wrong?
Right or wrong.
Look, I thought that was interesting because it doesn't feel like 2008.
No.
Although we have had 3 bank collapses that equate to, if not potentially more in terms of value than what we saw in bank collapses in 2008.
Yeah. And, maybe there's still something left field that we haven't thought of or...
I mean, there always is, right? Let's keep going because a couple of other things I want to share. Look, inflation's still sitting at 5%. The FOMC is targeting 2%. The market is pricing in cuts later on in the year, but I think expecting a cut anytime soon is probably wishful thinking. I think the best we have is probably hold for a little while and let that just sit at a higher rate. But I feel like the market is so smart now. Like the market is so switched on. The market responds so quickly. And the longer something stays on hold, it just gets closer and closer to a cut.
Yeah.
And so I just wonder if how quickly the market front runs some of the things that are going in the market now. It just makes the central bank's jobs really, really hard. Like if the market's got a whiff of what is expected, I mean, they'll act straight away.
Yeah.
I mean, gone are the days of, you used to be able to, what Wall Street used to do was have a look at the size of, central bankers' briefcases or how thick the documents were to make an assessment as to whether it's hawkish or dovish. But now they're so immersed in markets now, they're telling you exactly what they're doing, and they've done everything they've said that they're going to do.
It's definitely become much more responsive, hasn't it?
I want to bring this one up from Yardeni. This one looks at commercial bank loans and leases in $1 trillion. Seasonally adjusted. Have a look at the orange line is the consumer loans. Doesn't look like much is happening there. Residential real estate loans, interestingly, not much happening there as well. But the one to watch, the biggest one, is commercial industrial loans. So that's, business loans to companies, corporations. Contrast that to commercial real estate loans, which is you can see a little dip on the green one, but what's more pronounced is the red line. And you hear a lot of people talking about, you want to invest in private credit and you want to invest in good quality companies. I mean, good quality companies are good quality until they're not good quality companies anymore, right? And then, what security do you have? What this is showing to me, consumers look pretty robust, but what this shows me is that residential real estate looks to be relatively stable. You're not seeing any falls there. Commercial real estate, you see a small one there, but I mean, have a look at the volatility of commercial industrial loans. Not only now, but have a look at what we saw during the pandemic. I mean, we saw a rise and then a massive fall. You have a look during the GFC. You have a look during the tech wreck. It's uber volatile here. And do you have any comments on that?
Look,
or thoughts?
Yeah, that spike there in, say, 2020, that vertical spike.
But I think, yeah.
Is that a support function of
I think so.
Propping up companies?
I think so, yeah.
And then they basically really pulled that back once COVID started. Yeah. And now it's come back up again. And obviously due to the regional banking system, that's collapses of those banks, that's come back. Yeah, it'd be really interesting to see how this progresses and whether, in the next year or so, we see a further decline in, and I assume based on those Apollo charts that we're going to see a further decline from that second peak there over the next year or two.
In which
in the red and probably green lines, right? And so that's going to slow.
Well, interestingly, if you had a look at the commercial real estate from 2000 look at the decline in growth from like 2009 to 2013. There was just no appetite. No appetite whatsoever. But since then, we have an enormous run up.
Yeah. So I suspect we'll see something similar.
You reckon? Well, that won't be good for prices if you've got migration happening. Well, in Australia, you've got migration and you don't have supply. No one's borrowing money to go and build these things. It's a bit of a conundrum. Well, here's the latest. This is from Bespoke. Quote, "Don't be confused by panic price action in regional banks. The deposit crisis is subsiding. One example can be found in the reduced balances for emergency lending programs of the Fed. Those have fallen by $100 billion since March 22nd peak, a sign that stress is abating. And after failure of First Republic in the latest weekly data, 74% of the balances are now loans to the FDIC rather than funding for banks that have yet to fail. Data on bank balance sheets tells the same story. Domestically, banks saw deposits up week on week by a total $21 billion. What's even more encouraging is core loan growth rose. Total lending, consumer, commercial, industrial and real estate loans rose by $29.4 billion in the week of April 26th. That's a major acceleration. and was led by smaller banks in a sign that liquidity stress of deposit swings are hitting credit creation less than feared. That's good. So the bigger picture, that chart that we just showed, shows one sort of longer term picture, and it puts things into perspective. But again, because the history is that chart's so long, the numbers look incrementally small. They might be really big numbers, but the week-on-week numbers apparently, according to Bespoke anyway, they're saying that don't be confused by price action in the prices of stocks.
So basically now there's, in the last week, what they're saying is that there's less volatility around people pulling deposits out of regional banks.
That, plus with what's going on with the FDIC and the week-on-week loan growth is turning. Whether that sticks, I mean, who knows, right? So I think it's going to be one of those things that it's going to be measured week by week and seeing how it goes. So what does all of this mean for the stock market? I'll bring this chart up from Bespoke again. Consecutive monthly declines in year-on-year CPI from 1945 to 2023. We have seen 10 consecutive monthly declines, something we have never seen in the last almost 80 years. The latest one we saw back in 70 or 81, 82, we saw 8-month consecutive declines in year-on-year CPI, but it's unprecedented. We haven't seen this. And so inflation's moving, and it's moving quickly, and it's moving in the right direction. I'll bring this second chart up. I found this really fascinating by Bespoke. Quote Bespoke, we've summarised the performance of the S&P 500 in the year after every prior period where the year-on-year change in CPI declined by 5 or more percentage points in a 12-month span, with no other occurrences in the prior year. Following these 6 other periods, forward returns for the equity markets were positive. 1 and 6 months later, the S&P 500 was higher every time, with median gains of 5.17 and 13.52% respectively. So if you have a look at some of those numbers there, just by way of example, we use 2009 example for those listening, when we've had, again, similar occurrence with CPI declines. 6 months later, the stock market was up 19%. 1 year later, up 18.5%. During 1982, 6 months later, up 27%, 37% in 1 year later. And the list just goes on. I mean, the worst one there is 1947. But I think Bespoke point that out and say that even though the S&P 500 was lower in the year after the 1947 period, it was higher multiple times throughout the year. In fact, in all 6 periods shown, the S&P 500 was up at least 13% at some point in time in the next year, every single time.
There you go.
What do you think about that?
Yeah, look, I mean, there's so many different factors that would have impacted on each of those periods. You know, whether, past performance is generally not a indication of future performance. Sure. But, I mean, look, it'd be interesting to understand and dig deeper behind what was happening in those periods and to understand if there was similar drivers in terms of, I guess, GDP and market growth that precipitated these big rises.
Look, obviously this is only looking at one thing, right? It's just looking at what happened, what was going on with CPI, and then what did the stock market do then? There's a whole bunch of other factors that you need to have a look at. But look, I thought this is interesting.
Yeah, really interesting.
Not dissimilar to the chart that we looked at last week, maybe the week before, where we looked at the market cementing a bottom and it not making a new low 6 months after, and how the stock market has performed from there on in as well. And it looks
and it'd be
positive.
Interesting to understand whether the market in each of these situations has overcorrected due to in rapid rises in CPI, and therefore it's just this bounce back, getting back to a bit of more of a normal position.
Look, time will tell. I'm the whole question about when's the recession and are we in one. I don't think we can be in a recession now when you've got employment numbers so strong. Most Deutsche Bank, Apollo, and alike, most of them are talking about a second half recession. There was a great chart which I didn't bring up. It was quite confusing from Deutsche Bank, which looked at how many months later does the Fed start cutting after they pause, and it was quite interesting. It was I think the median time frame was about 4 months.
Okay,
and so most folk are thinking about a 4-month period from if we pause next month, so June 13th, I think or 15th, I can't remember the date, the Fed meets. They're saying if we pause then, we have July, August, September, there's no meeting in October, so we go to November, and then you start cutting then, and you're in recession at that point in time.
Yeah.
I mean, this is all crystal balling. That's what the market gurus and prognosticators are saying. We'll know in the fullness of time.
Yeah, we will.
What do you got?
Well, let's talk about what the Treasurer, Jim Chalmers, is saying.
Budget. Yeah, go.
In terms of where he sees the economy going.
Are we in surplus?
We are in surplus.
Is it?
We are.
Okay.
So
what does it even mean?
Well, it's an interesting one. So if we talk about the government actually delivering its first budget surplus in 15 years, I mean that's an interesting result. They're not profiling that to continue. So that surplus was led by wage growth and higher commodity prices that were overseen.
Commodity prices, the one thing you can't control.
Exactly.
The one thing that dictates your deficit or surplus.
100%. And they're predicting a move back to normality in terms of commodity prices, and therefore a deficit in the next further 4 years in terms of their forecast. Have a look at this chart that they've put in the actual budget document. I thought that was really interesting. Goes through major economic parameters. We look at where they're forecasting GDP, employment, unemployment, CPI, wage price growth, and nominal GDP. Have a look at we were talking about CPI before.
Mm-hmm.
So we were at, if you look at 2022-23, it was 6%.
So we're going from 6 to 3 1/4.
3 1/4.
Just like that.
That's right. And then the following year, 2 3/4. So they're expecting that to drop back to their forecast, within the next, call it 3 years, back to 2.5 by 2025. The one that I have been tracking is unemployment rate, and for obvious reasons why we talked about in terms of that being a major catalyst for problems in the economy.
Yeah.
The view is that over 5%, and we start seeing some mortgage stress, right? Where and big problems in the economy, but they're forecasting that'll stay pretty consistent between 4 1/4 and 4.5 over the next 4 years. So increasing from 3.5 in 2022-2023. So that's fairly interesting. They're obviously seeing that there could be a little bit more pain to come in terms of what's happening in the economy and globally that's going to impact on employment numbers. Any thoughts on your read of the budget?
One of the things that's been going around is how consistently wrong central banks have been, especially around employment forecasts. So being consistently wrong, consistently overshooting or underestimating the strength of the jobs market and of employment. And the RBA, their forecast for CPI have been consistently wrong. You made a comment before about something will come out of left field. Like my feeling is that there's just going to be no one can ever guess these things.
No, that's right.
That's why they're tail risks, right? something will happen that no one's predicted, and I just think it's an easy cop out for me to say, because I'm just saying something's going to happen. These numbers are going to be wrong, and I don't know what it is. But the point that I'm trying to make is that I don't think anyone knows what that is. Trying to push out forecasts for 2024, 25, 25.
Yeah. Look, it's
a lot of bullshit, to be honest. You know, especially if a lot of this hangs off what the commodity prices are doing. I mean, 1 minute, 2020, the beginning of the year, commodity prices going gangbusters. Next minute they're not, and you see that what's going on in emerging markets. You see what's going on in the US dollar. I don't know.
It just makes you realize how much more reliant and dependent we are globally
100%.
as a not just as a nation, but global collective.
Yeah. Look, I don't know what the future holds, but my sense of things is that we keep pushing rates to where they're being pushed, and I think something is going to break.
Yeah.
It has to.
Yeah.
It has to.
Yeah.
I don't know what that thing's going to be in Australia. In the US, it seems to have been the banking sector, but that seems to be just being sorted out. But I think the market is just screaming for a hold.
Yeah.
Everyone's kind of clinging on with, the last string and with, clinging on with fingernails with whatever their personal situation might be at home.
Yeah.
I don't know. That's my sense of it all. I think things are going to move a lot faster than what these forecast numbers are saying.
Yeah. You're probably right there. But the federal budget, this looks to be focusing on cost of living relief, which is probably a welcome thing to.
What do you think about that? Isn't that inflationary? Like providing.
Well, the way that they're trying to boost that is a lot of incentives for build to rent, for example, right? Which will increase supply. So the way they're doing that is, I think there's an incentive on. Hold on, I'll just pull it up now.
So the build to rent.
Yeah, so build to rent. Let's cover that now. So where was I talking about this? My computer's just carked itself. That's great. It's some incentives on depreciation for ongoing costs of operating these build to rents. So like it's gone from two. So it's doubled. Basically, the incentive is doubled.
Right.
So they're looking at a couple of incentives for build to rent. So I think if you look at build to rent in New South Wales, there's a 50% reduction in land tax till 2040, and then the surcharge
till 2040, right?
Yeah, surcharge purchaser duty and surcharge land tax exemption and refunds as well. And in Victoria, there's also a 50% reduction in land tax and exemption from absentee owner land tax surcharge of 2%.
That's exempt, right?
Yep, that's exempt.
Is this the solution to the shortage? Is the build to rent?
That's what they're saying. It's going to add, I think over 1,500 new homes in the short term.
1,500.
At least.
What does that short term? In the short, so.
I think there's probably more than that, right? Maybe I've got my numbers slightly wrong there.
And so, do you have to? Is that a new project?
150. Yeah. Why I thought 1,500? That's probably too low. 150,000.
That's better.
150,000 over the next decade. Sorry.
Over the next decade.
Yeah. Which is still not as much. Yeah, I mean, talking about immigration when we talked 600,000 as a number yearly, but look, it plugs probably a small gap in supply, right?
But do you then still have the problem of potentially rent still going up when we have these situations where you've got cost of living going up? In the next 20 years, no doubt we're going to potentially have. Maybe not, who knows, more inflationary periods, they're going to have tough times, rents are going to go up or whatever the case may be. Doesn't that sort of create more of that? Like everyone's whinging about rent and rent costs and.
Yeah, look, and lower income household owners, they've increased subsidies and all that sort of stuff. So to try and make things more affordable for the lower income, right? Look, I mean, there's probably not a Band-Aid solution to it that
What do you
works.
think? What do you think is the ultimate solution?
Oh, that's a good question. I think it's a combination, right? You've got to do a number of different things in tandem to generate the right outcomes.
Like what?
Well, they've got to, number one, increase supply. Number two,
how do they increase supply?
Well, this is one way of doing that, right? And incentives to the sector to increase supply. But yeah, you're right. I mean, it's a fine balance, and then you start creating inflationary pressures because everything's, when they had the homeowner grant, all that did was basically push prices up. So I don't know what the
that's a demand side incentive. I don't know how much of home ownership is the Australian dream anymore, but I mean it sounds pretty boring. But don't we need to unlock more land? I don't know what land the governments own, or incentivize the private sector to go and develop, but also develop more infrastructure to access those areas.
Which they're doing, right, with the suburban rail loop and increasing density around the suburban rail loop.
Bulleen Park and Ride.
Oh, yeah, Bulleen Park and Ride. I think
that's a great project.
Yeah, it's great. It's fantastic. Looks new. Looks basically like a train station. And they've even got... They had free coffees there last week.
Oh, really?
Trying to incentivize everyone to use it.
Do they do soy chais?
I don't think they do soy chais. You know my order.
I mean, even if you did that right, then if you've got these massive government projects, and then the private sector, maybe it's JV with private sector. Otherwise, you've then got these huge government projects, and they're taking staff, paying over, overs, and we've talked about it before.
I mean, there's just not. I don't think there's a quick fix solution to it, right? Unless you go. Well, even the route that China went with mass building and supporting the development sector to build massive new cities.
Just created a massive bubble.
Yeah, created a massive bubble, and people didn't want to move out there. And if you look at prices in Shanghai, they're still at all-time highs, right?
That's actually a really interesting point, mate. Like lessons learned. I mean, I remember newspaper articles, I'm sure you do as well. There would be headlines where China would be building roads to nowhere. There'd just be roads to nothing. Yeah. There'd be nothing there. But, I mean, what's got to go first? The infrastructure or...
Well, they've just built a new city outside of Beijing that they're encouraging all the financial services businesses to move out there.
How are they encouraging them?
Well, they're just basically telling them that they need to move there, right? So
how do you do that here, though?
Oh, you can't.
That's
impossible.
Yeah, see, that's a challenge. Anything else? What else do you want to chat about on the...
in terms of the budget?
I've got the most important highlight on the budget, which I'll save for last.
Yeah, save that for last. I thought the next table was pretty interesting around budget aggregates and net debt position. So we're looking at net debt of around 21% of GDP for 2022, 2023. Mm-hmm. And that stays pretty consistent, even though, obviously gross debt's increasing and they're forecasting GDP to increase, right? But that seems like a fairly stable sort of net debt position for us as a country, which is good. The other thing that was interesting to note was Australia's plan to become a renewable energy superpower. So they're investing some $40 billion in clean energy, which will be...
We talked about copper last week being a primary ingredient and driver for clean energy.
Yep.
Weren't there some taxes applied on EV vehicles?
Some incentives.
Was it incentives or tax? I think there was some taxes.
Well, you just bought the new Tesla, didn't you?
Yeah. Well, it's in the workshop getting fixed now.
But I think I was mentioning to you there's a I think from a personal tax return or corporate tax return perspective, there's a new 20% incentive on on going renewable. So I think up to $100,000 of spend. So that's another.
Oh, that's for businesses.
I think for businesses. So another 20% saving there if you go electric.
I think Lendlease were by 2030, all of their new developments are all electric. So ovens are electric. Like there's no gas.
Well, you can't do gas in new builds anymore.
Oh, so you can't.
No,
oh, right.
No new gas stovetops. So you've got to go. What do you call it?
Electric.
Electric. Yeah.
Yeah. My parents have got electric, and it's.
What do you think?
I don't know.
I like cooking with gas.
It's really sleek. Like it's really sleek, and you can just wipe the
easy to clean.
bench top down.
Yep.
You can use it. You can put stuff on it. I just can't.
Kids don't get burnt when they touch it,
Don't they?
I don't think so. It doesn't retain its heat, right? The heat gets transferred into the
I don't know,
pot. I think the
my
actual
kids can't reach probably that high yet. Neither can yours. But I can't use them well. Like the buttons are just. I don't know. Maybe I'm getting old. Like I can't use them properly.
when you touch it, you gotta hold your finger there.
Fucking hell, it doesn't work.
But yeah, we're going.
I hear
towards
you.
renewable energy superpower. Hey,
but it's like saying I like cooking with a wood fire barbecue. Like I'm having a wood fire. Yeah, man. Like how far back do you want to go, right? Like it's not like you're gonna have it's fossil fuel, right? That's the bottom line.
That's the bottom line, and we're moving away from that, which is I think a great initiative, and all the constituents want it. Everyone wants it. It's just investing in that program.
I don't know how the Chinese are going to cook their using the wok on the gas.
Yeah, I know.
That's a big dilemma.
I think you can still buy the gas tanks and do your outdoor wok. But there's another 20 billion in a rewiring in the national program. So they're unlocking investment. So the electrical grid, they're going to upgrade the performance of the grid, boosting energy performance.
Have you seen Tesla's product, their solar energy? So you basically have a box, like you have a grid in your house. It's like a box, and it captures the energy, stores it in there, and sucks it back out again. So it's almost
in terms
like
of battery.
Battery.
Yeah, nice. On the wall, the wall battery,
like a
right?
Big Tesla. Thing.
Are you getting one?
We just put solar in the house.
Well, that can still capture the energy, right? No.
I don't know. It's too hard. I don't understand. It's too complicated.
Well, with all these new grants, I'm sure somebody will be calling you about putting it
or they'll be at
a
shopping centre trying to grab me for some sort of...
Yeah.
My father-in-law loves that stuff. Gets his light globes changed.
It's pretty good.
He's all over
We
it.
had all our LEDs changed and everything years ago, and it's been really good.
Anything else on...
The only other thing was, I guess, what the Treasurer is predicting in terms of global growth. So they had a little piece in there. Global growth is expected to slow from 3.4% in 2022 to 2.75% in 2023, before a modest pickup to 3% in 2024 as inflation eases and financial conditions improve. Growth over the next 2 years is expected to be the weakest in over 2 decades, excluding the GFC and the pandemic. But global outlook remains highly uncertain, with the balance of risks firmly tilted to the downside.
Yeah, I think that's a fair
assessment. Nothing new to report, really, right?
That's a fair assessment. I think the other big one, mate, is the superannuation changes, where you've got the $3 million. You got the $3 million cap on superannuation balances, whereby they're going to be taxed. The big thing, though, is the unrealised gains or earnings of the fund are going to be taxed. So if your fund went up, 20% in any given year, that year you're going to be due for tax on that 20%, even though it's not unrealised.
Okay.
So that's causing a lot of angst amongst those that have sizable superannuation balances. I don't have an issue with an additional 15% tax. So effectively it's 30% on anything over $3 million. It's still below the highest marginal tax rate. It's fine. The other issue is that it's not indexed. So they're saying...
they need to index that, right? It doesn't make sense.
My belief is that'll change. I don't think you can keep it at not indexed. It's just... I don't disagree.
Either that, or they've just got to reposition it do an assessment regularly and reassess that limit,
which is a different form of indexation, right?
Exactly.
So I think that's a bit unfair. If we're doing budget forecasts for the next 20, 30 years, like I'm sure you can forecast everyone's going to be over a superannuation balance of $3 million in future dollars. Well, not everybody, but a lot more people than what we have now.
Yeah.
The other important one is vapes have been banned.
Yes, I heard about that.
You know,
so it's been banned.
Banned. Just that's it. You
blanket.
Can't blanket.
Wow.
It's like the tanning.
Yeah.
Sunbeds.
Yeah.
Just
gone. I think that's fair. It kills all these businesses that have basically set up on the basis that they'll be able to sell vapes. I saw one on this. Yeah, just
there'll be black market for sure.
Yeah,
100%.
Because it's not illegal globally, so people bring it in. The question is whether there'll be confiscation, fines, or whatever it is.
Yeah, who knows what the implications are? But I mean, I think that they were citing health issues and just causing a lot of problems.
Yeah, lung damage.
Just
in kids. Kids are
fucking ban cigarettes.
Yeah,
that
they should do that too.
Why can't they do that? What's the problem?
I don't know.
Oh, tax. Sorry. Very naive.
Yep.
Can we talk about property?
Yeah, let's have.
I think property is turning the corner. I'm going to bring this first chart up from CoreLogic. Their report was excellent. Their April or May report. What did I bring up here? This is the 3-month change in Australia, combined regionals and combined capitals. Have a look at the chart on the far right-hand side. For those listening, we have had a 1.4% rise in the last quarter in prices.
Sydney's back,
up 3% over the last quarter. Melbourne 0.3%, Perth up 1%. Hobart, Darwin and Canberra still down 2.42 and 1% respectively in the majors. And then regional SA, man, look at that, up 2.4% over the last quarter.
But regional WA.
Wrap all of that up. You've got 1.4% over the last quarter. Annualize that, you friggin' annualizers. What's that? That's like an annualized figure of, I'm slow, 6%? Something like that.
For the quarter, yeah.
Quarterly? No, not monthly.
I was
getting very excited. And we pointed this out a little while ago where we saw prices declining at the most rapid pace in speed and magnitude. And we hadn't seen, so if you look on the chart on the right-hand side, that dip that we saw, or the bottom some months ago, if you have a look going back for the last number of years, have a look 2013, 15, so we haven't seen this. We haven't seen this for a really, really long time. And so what that says is that something's got to bounce. I don't think it just keep going that way in the absence of extraordinary circumstances. The next chart I'll bring up is the annual one. Have a look at that. Just get that up now. So this is a 12-month change. We've got combined capital series. I mean, we're down 8.4%. But the most important thing here, I mean, look at regional SA, up 10% over the last 12 months. What's going on there?
We'll have to investigate that. That's an interesting one.
That's interesting. Hobart down 12. Hobart had a massive, and Tassie had a massive uplift during the pandemic. So I think that's been corrected now. People are realising maybe it wasn't such a good place after all. But on the right-hand side, for those that are watching, you can see the combined capitals just bottoming out and starting to turn. And for those listening, you've got this sort of a hockey stick now starting to form, or inverse hockey stick, if I can call it that. But you've got this hook. It looks like it's bottomed and it's turning. Now, the thing that we need to make sure is that you've got lending growth, because in the absence of lending growth, that is not sustainable. Again, this was from CoreLogic. This is month-on-month change in the value of house finance commitments ex refis. This is the value of home lending rocketed 4.9% higher over the month, led by a 12.3% jump in first home buyer lending. Some big numbers here. So you can see how you can see mortgages or financing starting to kick up as well. I think another supporting factor is that rates have probably peaked and the market knows what they're dealing with. This is what we're dealing with. This is probably the worst it's going to get. If anything, it's probably going to get better.
I think long-term fixed rates were down, I think.
Coming down.
Coming down. So everyone's predicting that, we're going to have a bit more stability around.
Well, stability, rates. Assuming you've still got a job, you can make those repayments.
That's right.
To your point, if unemployment starts rising, rates don't start getting cut for no reason.
No, that's right.
Right? So you can't have your cake and eat it too. But in my mind, the supportive factors are you've got lending growth, you've got a significant shortage of supply, you've got migration coming in, you've got some predictability about where markets are at, also where interest rates are at now, and people can price that into their their budgets. So you're starting to see that stability.
And with all the rising costs, I think if we don't see an increase or stability in the end value and the pricing, we're not going to get any more supply coming onto the market, right?
Went to an auction a couple of weeks ago. I don't know if I mentioned this on the pod a couple of weeks back, but over 100 people. I think they quoted 1050 to 1150 in Box Hill. It's a block of land, but the house wasn't. It's a block of land, 630 square metres, quoting 1050, 1150. First bid, 1050. Got to 12. The auctioneer just said, we're on the market. Sold for 1.45.
Wow.
It was
600 square metres.
630 square metres of land in Box Hill North. You could probably get 2 decent-sized townhouses on that. But that well and truly exceeded.
That whole area's gone
crazy.
Gangbusters.
It's crazy.
Yeah.
But what surprised me was the number of people attending the auction, how many bidders they had as well.
Yeah.
We saw it in the US, you're getting 3 solid bids per auction, per house sold. We're starting to see that in Australia as well. So look, I'm pretty bullish on this.
I think unless we see, as you pointed out, unless we see more mortgage stress. I mean, we're already seeing mortgage stress, right? So if you look at, there's a report by McCrindle Research that says 50% of mortgage holders are experiencing stress due to the interest rate rate. Well, stress means they're cutting back on their leisure. So they're prompting them to cut back more than 60% on leisure and social activities to manage repayments. And 28% have said they've taken on additional work, and 30% said they're considering taking on additional work.
But you know what? Having said all of that, when Andrew Papageorgia was here talking to him, who has great insight into what is going on with, line by line more borrowers when investing in some of these warehouse facilities with the banks. I mean, they're saying we're not seeing any issue there.
Yeah, that's right.
But they're two very different things, right? Everyone will always leave the house until the last line of defense, right? So no one will ever see issues there.
No.
They'll go get the extra job.
Yeah.
They'll
cut down on discretionary spend to put more money into the mortgage,
100%.
Right? Yeah.
100%.
And that's going to happen. And so the only breaking point to that is if you lose your job and there's more unemployment.
And why do you lose your job?
Well, there's something got to... Further problems with the economy, right? So that spiral we talked about in terms of lack of liquidity, businesses go under, more businesses start to go under, and that whole
or inflation just doesn't come down, and rates are high for longer.
High for longer. Things are not feasible.
I think there's a lot of fat that's being chewed up at the moment. So once that fat is chewed up, and you then get to sort of not much left, then I think that's where you start to, those hairline cracks become even bigger problems.
Yeah.
The question is whether you can get to that point and central banks can manage that soft landing they're all talking about. Yeah. But the reality is...
And then they'll lower rates and the economy will boost up again, right?
Yeah, in theory, that's how it all is supposed to work. But yeah, I don't know what the likelihood of that is. But jobs at the moment, remains strong. That's the bottom line.
Yeah. And even if the federal budget plays out in terms of that 4.5, 4.75 sort of unemployment rate, still below the 5 that everyone's predicting will cause mass pain, right?
Yeah.
So we'll see. I've got this other interesting graph. Have a look at surging rents. So this was a CoreLogic graph as well, but this is the rolling annual change in rents.
Rolling annual change in rents.
Yeah, have a look at that. So surged.
2020.
Yeah, if you look at 2020, that's from that point. Look at look at rents from combined capitals, national, combined.
What's
regional.
going on
That's
with the
all
regionals?
Going up crazy. Regionals come straight back down.
Are people realising that they can't live in regionals?
Yeah, where all my mates aren't here. I'm probably bored out of my mind.
Scott Keck made a comment. He predicted, and it was on the Masters in Investing podcast. He said, everyone's just jumping the gun. Everyone's getting excited about the regional thing. They will soon realise that when things start to go back to normal, and he said, I don't know when that's going to be, but people are going to start to realise that it's not what they thought it was going to be. Yeah. My friends, my kids don't have their friends anymore. I've lost my network. Yeah. I've lost my family. We're so far away, and you just don't have those amenities and the access, the infrastructure than what
majors have in a major city. Yeah, I agree with you, and there's probably a big proportion of people that choose to move out there that they genuinely want that sea change, but yeah, there's probably a large component of that as well that have buyer's regret, right?
Nationals looks like it's
stabilising, but look at Capitals. That's still on a massive tear, 11.7% over the past year.
I think a lot of that quite frankly has to do with interest rates and no development.
Yeah,
I mean, no one's developing because
fundamentally it's a supply issue, right? We talked about migration, we talked about rising costs being prohibitive for new development.
Yeah, no one's developing because no one's paying. I mean, we've talked this about in the past. No one's paying the price that the developer needs to sell it for in order to make the project feasible.
That's right.
That's just the bottom line, isn't it?
That's right.
Is there anything else?
No, I think that's it. So until that changes, I think we'll continue to see some rental growth there. The other one I thought was a really interesting chart, sourced from Longview, ABS, Stapleton, and RBA, was this composite Sydney and Melbourne house price index versus mortgage rates.
Right.
So if you look at the sort of orangey line and the dots, that's the estimated median property price doubling period.
Yeah.
So I thought this was really interesting. When you look at the doubling period between, I guess, sort of 1970 to 1990, and how much quicker that was. And when you look at the blue line and the average mortgage rate accelerating during that period, it looked, this is my point of view, but it looks conducive to a faster acceleration in actual house price growth.
What the hell's going on here? I'm confused.
Isn't that interesting?
You're saying we're doubling sooner through the 70s up until the 90s. The house prices are doubling quicker, but rates are going up.
Rates are going up, and then when rates are going down, and you look from 1990 to 2020, that period has extended in terms of house price.
Is that a function of just the fact that we've got bigger numbers that are having to double?
Potentially, yeah. Potentially, you may be right about that.
Is there a different psyche as well? Like through the 70s, 80s, and 90s, like, you know, I know my parents were just very much gung-ho about repaying loans and everything was on P&I.
Yeah.
And now everything's on fucking interest only and people are like, we'll repay that later.
Yeah.
We'll repay that later.
We'll borrow as much as we can.
And just gear up, right? I mean, that's why we've got the debt levels we have now.
Yeah. But as you can see, look, it looks like the new sort of duration, at least from 2010 to 2021, that's, it looks like it's a longer period to double now. And it looks
like 10 years.
Yeah, more than just over 10 years, where typically previously we talk about 8 years, right?
I don't know. It was always the 7 to 10 year doubling. This is a rule of thumb.
Yeah,
but that's really interesting. Think higher rates and doubling sooner. Maybe there was just FOMO, like let's just get it now before it keeps going up.
Potentially. Yeah, I don't know the driver to that. It'd be really interesting if any of the listeners had a view on it and wanted to chime in. That'd be good.
Yeah, that is fascinating actually. Very insightful. Anything else you want to add to that?
No, that's.
Do you want to go director's cuts? Oh, you've done your director's cuts.
Yep.
Well, here's my director's cut. This was Cathy Wood of ARK. ARK Invest, Cathy Wood says, Elon Musk is a renaissance man.
Wow.
So I can't remember what conference they were at. So she was talking about how, massive investor in Tesla. She's going hard on Twitter. This is Wood quote. We are so excited about what he's doing. He is the inventor of our age.
Wow, the real life Tony Stark, eh?
ARK Invest is projecting that Tesla's stock would hit $2,000 per share by 2027. That's a 12-fold increase. Do you know what that means? That stock needs to double every year for the next 4 years. Can you imagine the stock going up 100% every single year for 4 years?
It's pretty incredible. I mean, they're doing some amazing new technologies, right?
Okay.
With SpaceX.
Yeah. They are.
What's that global satellite Wi-Fi thing that he's put up now? SpaceLink or something?
I know what you're talking about. I think it's SpaceLink. It's the global free Wi-Fi.
Yeah.
Free internet.
I mean, it's pretty amazing.
Mate, I don't disagree. And this was exactly the point that I was going to make. Let me bring up... I won't bring this up now. GoPro.
Okay.
Amazing company, amazing product. I love using my GoPro. Holidays, I'm not leaving anywhere with it, right? Like, great product, great entrepreneurship, etc. Let me bring up their stock price. GoPro.
They got smashed.
Right, so $35 on IPO. I can't remember what the IPO price is. They hit about $90, and then now they're $4. And yes, I mean Fitbit's the same thing. There are a lot of companies that do great things, but it doesn't necessarily reflect in the share price.
Yeah.
And you look at another example would be Disney. Like Disney's just been doing incredible things, especially over COVID with Disney Plus, their streaming service. I mean, they were hammered with the parks getting closed down. They reopened with a bang, and people are back again. But if you look at that stock over the last 10 or 15 years or 20 years, I mean, it hasn't really done much. And so
Is
I think
a reflection of earnings, or what was it a reflection of?
Of course, a reflection of. I mean, stock price is moved by earnings. That's what drives.
So you're saying that even though they've got such pervasive user base, they're not getting the growth.
Or they're not getting the growth on the bottom line.
On the bottom line.
Like EPS is probably not doing what it's supposed to be, even though they've got an awesome product.
Yeah, amazing product. Yeah.
So I love my Tesla. I'm missing my Tesla every day. I can't wait till it gets back. So I love the Tesla. I love the products. I'll buy what Elon says that I should buy because I'm weird like that. But does that necessarily mean Tesla is an absolute killer of a stock to buy? I don't know. Maybe it is. Maybe it isn't. So I mean, just because I don't know, wearing Nike shoes doesn't mean I should go and buy the stock. It could be two different things.
Look, I think one thing different from GoPro is he's actually tapping completely new user bases and completely new markets, right? So Tesla with EV and cars is one market. This Starlink or whatever it's called is tapping the whole ecosystem around internet providers, phone providers, and then SpaceX obviously is for that's blue sky sort of stuff, right? And they're talking about using that for freight, for like global freight, so you don't even need ships anymore. They're just saying, and that the time for freight is a lot quicker because you're going through the atmosphere. So there's, I don't know, I'm feeling like it's he's scaling into a lot of different areas or sectors that are not what you normally think of Tesla as, just the car component, which is, I think, maybe what Kathy's saying is where they're going to get their growth out of.
I don't disagree. There's a number of different lines within Tesla or within whatever he's doing. I also feel like, especially with Tesla and other things that he's been working on, being the first out of the gates, there's a lot of skepticism. There's a lot of very capital intensive, a lot of R&D that goes into this, and you don't necessarily make that up.
Just to caveat that, I think you're right though. Tesla is a separate company to SpaceX and all the other companies as well. So
yeah, I mean,
having that specific area hit 2,000 per share, maybe,
Yeah, I mean, that's just Tesla, right? I mean, she's then talking about Twitter. I mean, Twitter's separate. So yeah, I hear you, but I also feel like he's what he's doing has been groundbreaking, right? I don't disagree with any of that. I love what he's doing. I love just his ability to go out and his entrepreneurship and just create new things. He's almost, the Renaissance man. But I think what he's doing is paving the way for others he's forging the path for others to be involved. I mean, is Tesla the number one margin maker on EVs? I don't know. I think they might be, but there's a lot of Chinese now companies.
BYD.
Yeah, man.
Build your dream.
Right?
It's amazing.
So, and could that have been possible without Elon Musk? I don't know. No one will know. But what we know now, it seems as though, yes, because of what he's done, has forged a path for others to follow.
Yeah.
Does that necessarily mean he's going to make all the money? I don't know. Maybe not.
On BYD, supposedly their factories are amazing. I mean, I'm going to check this out later. I was listening to the Berkshire Hathaway annual
AGM
conference, and they were saying they went into the factory, and basically it's like all automated.
Yeah.
So they've got all these machines just working, building these cars.
Yeah.
And it's supposedly incredible.
Yeah, I've got no doubt in my mind. Just for clarity, Disney, it's more over the last 5 to 10 years, not so much over the last 20 years. That was just an example that I had around what was going on in the pandemic, post-pandemic, even though they had record attendance at theme parks, etc., just didn't reflect in the share price. That's all I had on director's cut. You got any tips?
Not for this week. Anything from you?
Yes, I went to... I don't even know what it's called. There we go. Thank you, Google Maps. Midori by Tao's Sushi.
That's the place you're talking about.
Yeah, Midori Sushi. It's on Doncaster Road in Balwyn. Balwyn? Really cool, really boutique. So they got sushi train downstairs, and it's all vegetarian. Most of it's vegan, and it was really cool. The kids loved it. They're like, I can eat everything here, basically.
Oh, great!
And so they're just sitting next to the train. They're just picking off, all the different dishes. Although I always feel like wherever you go, ordering edamame beans is such a rip-off.
Yeah.
Like you buy
you can buy the freezer bag.
So the kids loved it, and they had the mini delivering the food if you order hot food. So just the deep fried enoki mushrooms,
delicious.
The hokkien noodle soup, amazing. It was so good. It's really high quality, really well priced, and they've got fine dining upstairs as well.
Okay.
So you can.
And is that vegetarian as well?
Yeah, all vegetarian.
Midori.
Midori, Midori. Midori by Tao's. Yeah, Doncaster Road in Balwyn North, Doncaster Road.
Okay.
You know where the Belmore shops are?
Yeah.
Belmore shops? Just
really
up there.
Convenient.
Yeah, it's not too far.
Yeah,
so worth checking out if you're vegetarian or vegan for Sushi Train. I think it might be one of the first vegan sushi trains. Anyway, let's wrap up. We'll hit us up on LinkedIn, YouTube, Spotify, Google, and Apple, and we'll catch you guys next week. My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me and or our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.